Hi everyone, this is Jason Barrick of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a returning guest. He's worked in the financial industry for over 2 decades, including as a portfolio manager. He co-founded Real Vision TV, which I think is great, with Raoul Pal. And he's been writing the Things That Make You Go, newsletter. And he just started pretty recently the Adventures in Finance podcast. Grant Williams, thank you for joining me again.
You're welcome, Jason. Although there's one thing I have to correct about that very generous introduction, and that is the 2 decades. Sadly, it's over 3 now. So I just feel like full disclosure is important here. So yes, it's over 3.
I've seen you on video, man. You still look pretty young. So
I know I am that old. Believe me, I am that old.
When did you start working in finance? Right out of college?
1985 was my debut in finance, just in time for the '87 crash. Yeah, so it's just a lifetime ago. Completely different world back then, that's for certain.
Since I know you travel a lot all over the globe, you're always traveling. In your opinion, how's the global economy doing based on your travels?
Well, it's excuse me. It's an interesting question, and I don't think there is an answer to it. I think this idea of a global economy is just wrong. There are a bunch of different economies, and I think if you go to certain places in the Middle East, certain places in Africa, you'll see, and frontier Asia, you'll see booming economies. But the Western economy, I think, is stale. It's stagnant. We're much closer to the end of the current expansion than the beginning. That's for certain. How long it goes on for from here, I don't know. But however long it does go on for, it will still have been the weakest and most anemic recovery on record. So, I feel like we're in a new era now where 2% growth might actually be pretty good, and that's not to say it's a bad thing. But the problem comes with the market coming to terms with the fact that 2% is pretty decent, because in a world where 2% growth is pretty decent, equities are probably 50% overvalued. So that's a reckoning that the market's going to have to come to in its own sweet time, and I suspect if it does, it's going to be rather painful.
Yeah, there's been huge dislocations really since the 2008 financial crisis and the unprecedented level of intervention with central banks between the real economy and asset prices, and it doesn't seem like it's getting better. I hear, Grant, that capitalism and free markets get blamed for this wealth gap, this wealth disparity, but it seems to me a lot of this wealth gap has been exacerbated by the intervention of central banks, and the 1% or the smaller than 1% who have been holding real estate portfolio, bonds, and stocks, they've benefited from the central bank intervention even more.
Well, I have to laugh when I hear these conversations about how capitalism's failed and how the blame gets put at the feet of capitalism, because the simple truth is we don't have capitalism anymore, certainly not free market capitalism. In free market capitalism, we wouldn't be in the state we're in today, because we would have had a cleansing of the cycle. We would have allowed for the downward half of the business cycle. We would have allowed companies to go bankrupt, so unemployment to increase. 2008 would have been allowed to run its course if we had pure free market capitalism. So when people talk about the problems with capitalism, this wealth gap, to me, it's completely disingenuous to lay the blame for that at the feet of capitalism. So I just won't listen to that argument, because I think it's spurious. I think that the wealth gap has been created by central bank intervention. I think at the beginning it was well intentioned, but it's morphed over time, and we're almost a decade into it now. It's morphed into self-protection, because they realize now that it's clear where the blame lies if the markets fall over. And so they are now doing everything to keep the markets up rather than try to stimulate the economy. And I think these are natural forces they're trying to tamper with. And to me, as I've said often when I've given speeches around the world, these natural forces, you can kind of hold them at bay for a while, but ultimately they are way more powerful than man, and they will ultimately win out. So I do worry what happens when the natural forces which have been suppressed return.
I completely agree. And there's just been huge moral hazard put into the system because, there hasn't been bankers, banking executives have been prosecuted for fraud. There hasn't been large firms that should have went bankrupt. Instead, they've got bailouts. So this has put, a perverse system of incentives into the system now, and people think that they can get away with a lot of stuff. And, that's why we have these trades like this short volatility trade that I think you interviewed Christopher Cole a couple months ago that he's been tracking. I think, the central bankers initially started this trade, and then you've had all these hedge funds and other day traders start piggybacking this trade with leverage, betting that the central banks are going to not allow asset prices to crash.
Well, you've created an environment where short volatility is the best performing strategy in the world by some distance. And so, of course, it's attracting more money. And if you artificially dampen volatility by ensuring every time the market looks like it's going to fall over, you have this central bank put coming in, that's what you're going to do. So low volatility begets massive inflows, which begets low volatility. So we're just in this circular period right now where more assets are moving into short vol strategies because it has been such a winning trade, at a point where being short vol arguably has never been more dangerous. And that will resolve itself. I mean, people kind of sit around and bemoan the state of various things, whether it's central bank intervention or low vol or all-time high stock markets or lackluster volume on the exchanges. People moan about those things. Ultimately, they will fix themselves. And the antidote to low volatility, unfortunately, is high volatility, and that's going to cause an awful lot of pain when it returns. Now, we don't know when it will return, but we know that it will, because human nature is volatile, humans are volatile, markets are volatile, the world is volatile. So if anybody wants to look at what's going on in the world, whether it be in North Korea, whether it be in Europe, whether it be politically in the US, Britain, wherever you look around the world, there is inherent volatility, and yet financial volatility is telling you that doesn't exist, and when it clearly does. So at some point, real volatility will reemerge, and when it does, equities and just about every other risk asset on the planet is priced incorrectly for that volatility to return.
Yeah, I agree. And the short volatility trade seems to have become an overcrowded, one-sided trade for the most part. And, I was reading a Chris Cole interview. The New York Times interviewed him. It was a very skeptical piece from the mainstream financial media journalists. He didn't interview other hedge fund managers like Kyle Bass or Hugh Hendry or yourself that have said, that is one of the bigger problems that's growing and festering in the markets. It seems, Grant, that before the 2008 financial crisis, a lot of the problems where there were either asset bubbles or credit bubbles were in the billions or tens of billions or hundreds of billions. But now, because of this unprecedented levels of central bank intervention, a lot of the new problems, either reflated credit bubbles or asset bubbles or new bubbles like the subprime auto loan bubble, it seems that the new problems, Grant, have gone from the billions level into now $1 trillion or more in size.
Yeah, look, absolutely. But look, I mean, people are scratching their heads wondering where the inflation is that all this stimulus was supposed to produce. And you just answered the question. What we've seen is a naught added to everything. The inflation isn't in the CPI basket, although I would contend real inflation is nowhere near the government figures, but the asset price inflation is extraordinary. So, of course, the money has gone to wealthy people who have a very low propensity to spend that cash. So the money is piling up in people that own assets. They don't put it into the economy and go out and buy stuff. They buy assets. So we've seen property prices, we've seen art prices, we've seen stock markets, all these things that a very small percentage of the economy are owners of, go through the roof all around the world. And yet people scratch their heads and say, well, where's inflation? Because they equate inflation to rising bread prices and rising food prices. And while they are going up significantly more than the CPI would have you believe, they're not increasing in price to the same extent as physical assets like property and stocks. That's just the way of the world. I mean, it's so obvious what's going on, and yet there seems to be this inability to acknowledge it amongst central banking circles.
Yeah, well, a lot of people are still making money off this trade that are long stocks and trading the FANG stocks back and forth. But you recently had on Kyle Bass for a very long interview. I thought it was great. For our listeners out there, our Real Vision TV subscribers, they should definitely check that out. I want to ask you now about China's banking system and non-performing loans. How big of a mess do you think this really is based on your travels and talking with your other contacts who have researched this?
Well, look, China's the great unknown. Nobody really knows what's going on in China, including, I hasten to add, the Chinese. It's such an opaque system, and they have so many levers they can pull, and they just operate under different rules. Kyle's laid out a very, very compelling theory He's talking about 40 trillion of credit on a monetary base, I think, of $2 trillion. Whichever way you look at it, the credit expansion in China is unprecedented in modern history. And ultimately, things like that don't tend to end smoothly. But we don't know when they'll end. We don't know how they'll end. Kyle's case is that the end game is going to be played out through the currency, which will devalue significantly. A lot of very smart guys. I spoke to Hugh Hendry the week after we spoke to Kyle, and Hugh takes the other side of that story, and both of them make very good cases for why. For me, when people talk about China, I try and simplify things and step back and say, well, look, this is essentially a group of first-generation capitalists, and they are trying to stick a landing that no capitalist country has ever managed to stick. There have always been massive busts after massive credit booms. That's the way of the world. So to think the Chinese can somehow manage this effectively and avoid that, I think is just pure imagination. But until it happens, it doesn't really matter. They'll keep going, and the end will come in one shape or form, whether it's part of a synchronized global bust or whether China has its day of reckoning on its own. I honestly don't know. Kyle thinks it happens before the end of 2018, and he may very well be right. As I say, his case, as always with Kyle, is incredibly well researched, incredibly well stated, and it's hard to find any holes in it. But the simple truth is with China, we just don't know. The numbers are big. The system is opaque. The measures that they can and will implement are essentially limitless. And when things get desperate in somewhere like China, unlike the West, where the downside is a change of government, the old guys get voted out, the new guys get voted in China, it's a lot more serious than that. If the people end up with soaring food prices, it's not, you don't vote out the incumbent party. You go to where they live, and you knock on their door, and you have a few unfriendly words with them. So the stakes are much higher in China. So I suspect they will do things that even the West were perhaps too timid to take on.
And timing is the key word there. Timing is extremely difficult. I mean, you could have the fundamentals right and be totally off on the timing, and you lose all your money on the trade. People have been talking about Japan collapsing for years, and yet all this monetary inflation that Japan's been able to create, whether it's through the yen carry trade or other things, they've been able to export a lot of it. And that's, one of the things that has helped propel a lot of U.S. asset prices higher. I think there's been a lot of money, Grant, that has left China either in, and that's one of the reasons why they maybe haven't had another big bust, is there's been a lot of money leaking out, whether that's in the skyrocketing Bitcoin and altcoin and initial coin offering prices, or in these real estate prices in Vancouver, Toronto, London, and other cities in the United States.
Well, you bring up Japan, and it's a very interesting situation there. And once again, Kyle laid out what he called his rational investor paradox, I think maybe 5 years ago now, talking about Japan and why Japan was going to have a bust all of its own. And again, the currency was going to be where this would play out. And again, his logic was incredibly well thought out, very eloquently stated, and to my mind, impossible to find a flaw in. But what Kyle didn't know, and none of us could have known then, is the lengths that the Japanese, the Bank of Japan, would go to prevent that collapse. The Bank of Japan owns 75% of the ETF market. They own, I think, 36% of the JGB market. And so if they are going to take such extreme measures and be allowed to do so by a compliant market that understands that, well, we can ride this trade with them if they're going to keep doing this, then yeah, I mean, if the Chinese take similar measures, it can go on for longer. But I think what happens is, as the Japanese do it, the next guys who get to try and do the same thing and think, well, it worked for Japan, we should try this. I think the level of skepticism rises with each passing attempt at things like this. I think if the Fed are to go out and start buying U.S. stocks, I think their credibility will last far less time than the Bank of Japan's has, because it's just a much more important central bank on a global scale. So just because something's worked doesn't make it a good idea, and just because something bad hasn't happened doesn't mean it won't happen. It just, to my mind, has pushed out the inevitable day of reckoning until the markets arbitrarily decide that we're just not going to play this game anymore.
That's a good point. And Japan was the first country doing this. You know, when they had their bust, I believe you were working in Japan in the late 80s, early 90s when they had their bust, when I think a tiny little amount of real estate in Tokyo was worth more than a good amount of real estate in Southern California. So things were just way out of whack then. But Japan was the only country doing the central bank intervention with the amount of debt monetization. And, you know, now we have a lot of the G7, whether it's the Bank of England, the European Central Bank, the Federal Reserve, all doing similar activities to it. Ben Bernanke, he wrote a white paper, I think, before he joined the Federal Reserve, saying, in theory, that if all these central banks took turns intervening and coordinating, monetizing debt, either lowering rates, expanding their balance sheets, that it wouldn't look like real inflation in the real economy. So far, you know, they've been able to put this illusion on the markets and somewhat have gotten away with it. But you're right, the long-term consequences, they haven't disappeared. They've just been delayed and probably magnified.
Yeah, I don't disagree with that. You know, Bernanke himself said something which I have to give him credit, was actually very smart. He said the trouble with quantitative easing is it works in practice, but it doesn't work in theory. And that's exactly right. It's a bizarre thing, but then everything about quantitative easing is bizarre. Unfortunately, these guys have had success with this, success measured by the fact that the world hasn't fallen apart. So unfortunately, it's just emboldened them. You know, you look at what's happening with the Swiss National Bank, it's absurd. I mean, it's an $85 billion hedge fund. And now the Swiss franc is backed by Amazon shares, as Jim Rogers said to me this week, which is ludicrous when you think until a couple of decades ago it was backed by gold. I mean, this is just farcical. And there will come a time in history when people are looking back on this period and reading the books, and they will study this period as an example of how madness can overtake what are supposedly sensible institutions. You know, there will be more books written about the last 10 years and the next 10 years, I think, than any time in history since World War II, and for very good reason, because these are truly extraordinary times, which look okay at the moment because things haven't fallen apart. But we all know that you cannot just create wealth out of thin air and expect it to work out okay. I mean, anybody that thinks that's a viable possibility is out of their minds. I mean, if that were possible, why does anybody get up in the morning and go to work? I mean, it just doesn't work. But for the time being, it is, and we have to deal with that environment.
Yeah, and they've pumped liquidity after liquidity, trillions, over 18 trillion since the 2008 financial crisis in money and credit created out of thin air liquidity, but it hasn't solved the solvency crisis. You know, you can't solve a debt problem with more and more debt. Look what President Trump, you know, ran on a platform to talking about the Federal Reserve rhetoric, that they were manipulating interest rates lower, that they're creating bubbles in stocks and other things. And now look, it looks like he's going to be a big spender on military, and there's going to be big subsidies for his new healthcare plan. Since you did bring up gold before we talk about President Trump, do you think China wants a gold standard, or why do you think they're accumulating a lot of physical gold, private Chinese citizens and the Chinese government?
Well, I would just go back to something you said there, which is quite interesting. You said, you know, you can't solve a debt problem with more debt. And unfortunately, that's not true, because if the problem of too much debt is a potential collapse, then we've proven through the actions of the last 9 years that you can solve that problem by more debt. You know, ultimately, it will not work, but for the time being, the problem has been solved by more debt. You know, global debt has increased by, I'm not even sure what the number is, it's maybe 100 trillion since 2008 in total. I mean, I know 3 years ago it was 57 trillion, but you know, global debt has increased by tens of trillions of dollars, and that has, quote unquote, solved the problem for now. Ultimately, it won't work, but when you're looking for short-term solutions, more debt clearly is a good one for you. So yeah, that, I think, is a big part of the problem, that optically, this piling on of more debt seems to have made the problems go away for now. Getting back to your question about gold, I think the Chinese understand the value of gold. They've been accumulating it for a considerable amount of time. They're the biggest producer in the world, and they don't export a single ounce of that. And they are voracious importers of gold. So I think it's very clear that they are trying to accumulate as much as they can. I'm sure they're very happy that the price is staying relatively stable while they do that. Do they plan to back the yuan with gold? I don't know, possibly. I think probably right now they won't do that, because what they really don't want is a strong currency. And if you had a gold-backed yuan, it would be the strongest currency in the world. So I don't think that's in their immediate plans. But having $3 trillion of reserves in treasury bonds without a decent amount of gold to hold against it, should those treasury bonds start to decline in value, which is eminently possible should we get another crisis, is not a smart thing to do. So I think the Chinese are playing the long game, as they tend to do. They're accumulating as much gold as they can while the price is where it is. And not just the Chinese, the Russians are by far the biggest central bank buyer of gold. And everywhere you look, sort of from Eastern Europe eastwards, they're all trying to accumulate as much gold as they can. It really is only here in the West that we really don't care so much about gold, and that comes down largely to the fact that we haven't needed it for most of our lifetime. The last time anyone in the West really needed gold was during the hyperinflation in Weimar Germany. So for the best part of 100 years, no one in the West has really needed gold. It hasn't had to do what it's supposed to do, which is protect you from pernicious governments and protect you from hyperinflation. We haven't needed it. Go to South America. You'll find plenty of people that have needed gold in their lifetimes. Go to Asia. Go to Africa. Go to the Middle East. You'll find all these people there. They will understand it. We just don't happen to not understand it here in the West.
And if China goes on a gold standard, they're not going to be able to do the bailout that they're probably going to have to do in the near future then with, those non-performing loans in their state-owned banking system. I think their government owns around 90% of all their banks in mainland China, and then all the municipality loans that are bad. So they would probably not want to go on a gold standard anytime soon until they take care of that potential bailout, because that's what it's looking like.
Sure, yeah, most likely I would agree with that statement, yeah.
Now I heard Kyle Bass talk about a trade war with China, and he thinks that's a good thing. I've looked back through financial history. I don't think anyone wins in a trade war. I think maybe some manufacturing could come back to the United States if Donald Trump does start a trade war with China, but that the manufacturing wouldn't. It would be capital, but it wouldn't be a lot of jobs, because it would be robots and automation. So do you think there's a high probability of a trade war in the near future with China, and what do you think would be the potential result of it?
Well, look, I mean, I'm racking my brains trying to think of any kind of good war. I mean, the only one I can think of is Edwin Starr's disco hit from the 1970s. But
how about a price war, which is good for consumers?
Well,
right?
yeah, possibly. but it's these things tend not to end well, and I think Trump laid out his stall when he announced his administration. When you look at Lighthizer and Navarro, the two guys he put in charge of negotiating with China on a trade basis, they are very vociferous anti-China guys. They believe China have been cheating on trade for years. These guys have written books called Cheating China, or I forget what they were. I looked at all these book titles once, and they're extraordinarily blunt in their assessment of China, as has President Trump been. So I think at some point we are going to get into that. We're dancing around the edges with steel tariffs and stuff already. I think it's coming. I think that will happen because, as Ben Hunt of the excellent Epsilon theory always says, you have to remember that domestic politics always trumps international politics, and ultimately, when the domestic economy is not doing well, there's your priorities. And Trump was elected to bring jobs back to America, to reinvigorate the heartland, the manufacturing base of America. And the easiest way for him to look like he's doing that, whether it'll work or not, I guess initially doesn't matter. He needs to look like he's doing something, and that would be to start punishing China, who is seen as the country that's taken all those jobs away from that manufacturing base. So it's a politically sensible thing to do from an optics perspective. Is it a smart thing to do in the longer term? That's much more debatable, in my opinion.
Yeah, I don't think anyone in the long term wins off a trade war. But, when you have all these countries trying to do mercantilism policies, it's just not going to end well. The only good type of thing is like a price war, where you have, a bunch of large companies and small businesses all competing in a market, and that's good for customers because you get higher quality goods and services at low prices. So, but we don't see that many of those anymore, where there's like a price war and people are offering higher quality goods and services at lower prices. That seems a lot less frequent nowadays than what it used to be, probably.
Well, look at Amazon, buying Whole Foods and then cutting prices by 25%. That's not designed to necessarily help the customer. That's designed to crush the opposition, and you can bet those prices are going up more than 25% if they manage to achieve that. So
Exactly.
yeah, even price wars don't necessarily have good endings, unfortunately.
Yeah, and Amazon can afford to run Whole Foods at a loss to accomplish that, whereas most other businesses can't afford to do that.
Yeah, no, exactly right.
Since I know you talk to so many of the smartest minds in finance and hedge funds and institutions and private investors, would you say that Bitcoin is stealing investment capital and demand from gold?
I'm about to alienate half your audience, I'm sure. It doesn't matter what I say about Bitcoin. It's that kind of a polarizing issue at the moment. To me, right now, I think Bitcoin is clearly a bubble. Every sign you could possibly, every box you would want to check for a classic bubble is there. Now, that's not to say I think this thing is a waste of time and it's going to zero. I think blockchain technology is absolutely revolutionary and will change everything that we know going forwards. But this let's call it cryptocurrency bubble is very, very clear to me. I'm not, as I say, I'm not doubting the long-term viability of blockchain technology. I think it's just phenomenal. But I think right now you talk about is it sucking away investment capital? No, I think it's sucking away speculative capital. I don't think anyone's genuinely investing in blockchain at these prices. I mean, the guys who were investing in blockchain did so when it was a nickel 5 years ago. So no, I don't think it's taking any investment capital. I think it's all speculative capital, and I wait to see what happens to these cryptocurrencies when we have a 2008 event. They haven't been tested under stress conditions, and we saw with the Chinese situation just this last month when the Chinese outlawed trading in these things, just what can happen were governments to step in and make that kind of decree. If governments say these things are illegal, they're illegal, and while they'll still be traded by people, most of the volume will go out them. Most people are law-abiding citizens. They don't want to break the law. So if you tell 100 people that, hey, you know what, owning those is illegal, 97 of them or 98 of them will sell them right there and then. So look, I think it's too early. I think Bitcoin has a tremendous future. The blockchain has a tremendous future, but right now, when Paris Hilton is issuing a coin, and Drake is issuing a coin, and Kanye West is issuing a coin, Burger King are issuing a coin, I'm sorry, but that is a bubble.
I would take a little bit different stance. I actually like Bitcoin, and I'm not sure Bitcoin's a bubble. I know a lot of capital speculative money is going in there, but I think there's a lot of legit innovation in there. What I think is the bubble is a lot of these other altcoins that are riding the success of Bitcoin that don't really have any innovation, and then also these initial coin offerings. Are you getting a lot of these like spam emails about weird types of initial coin offerings where what the money will be used for is changed every day, or it's worded basically like in a Nigerian chain letter?
I am not. I've obviously set up my spam filters very effectively.
I went to a blockchain technology conference in March in Washington, D.C., and they must have had my email address there, and they must have sold it to some of these marketing firms in New York City and San Francisco, because I've been getting like daily ones Monday through Friday now, like weird, where the coin will be the same, but what they're going to use the money for, it's changing from like robotics to biotechnology. And then there was like a Western African telecommunications ICO. I'm also getting ICOs promising me $1,500 in free tokens if I do an endorsement video for them.
Well, look, to my point, this is what a bubble looks like. This is what a bubble looks like. Cryptocurrencies are a bubble. Now, once the bubble goes away, there is some phenomenal money to be made, and already phenomenal money has been made. But in everything, phenomenal money is made, and then a phenomenal amount of money has to be lost. Look back at the internet bubble when we saw the Nasdaq fall 85% in 2000. But what came out of that was the backbone of the internet, for example. So the reason we can have internet for $9.99 a month now is because the WorldComs of the world and the global crossings of the world spent all that money on laying the infrastructure and then went bankrupt. So what emerges once the price bubble in cryptocurrencies is deflated is a long-term buy and hold. There's no doubt in my mind. But to chase it around here, when you see the kind of feverish speculation, the kind of wild price moves you get, that kind of thing only really happens under bubble conditions. So right now, I don't want to play, but when things settle down and we start to lower the volatility, and we're not seeing 25% moves in a day, then it's time to take a look. But whatever happens with the coin side of things, the underlying blockchain technology is absolutely revolutionary.
Yeah, I don't know if I'd want to short Bitcoin, but if there's
no, I'm not talking about shorting it. I'm just saying that. No, I'm not, look, why would you do that? I mean, it could double, triple, quadruple from here. I don't know, but what I see is the flows into it. These are not investment flows. Stocks that are at the stage where they are seeing investment flows don't go up and down 30% on consecutive days. That doesn't happen. So this is speculative hot money. Driving these things up, and it's a very limited supply commodity. And look, good luck to everybody that's playing these things. I hope everybody makes money. We know that can't happen, but I think looking at it through the eyes of an investor, right now at this level, Bitcoin is not investable. Is it tradable? Absolutely, but you better be nimble. But I don't think to me, it's not investable right now.
Yeah, I've heard so many success stories, anecdotal ones of people, doing crazy trading of cryptocurrencies. In March, I heard of one Bitcoin miner. He was a college student. He maxed out his student loans and bought mining rigs to mine Bitcoin, Ethereum, Dash, and Ripple, and he made a fortune. He paid off his student loans in only a couple of months, I think he said. And so then even a couple of months ago, some guy timed adding another mortgage onto his house, and he bought Bitcoin and he paid it off in only a couple months. And I was even at a Ron Paul Institute conference a couple weeks ago, and some guy, I don't think he knew anything about the technology, and he told me he was making 1 or 2% a day trading Bitcoin and other cryptocurrencies. So the sentiment levels, this is exactly like you said, the 1996 to 2000 internet bubble before the crash, where people basically, if there's any dip at all, people are like, ooh, I can add more. So that's kind of buy the dip mentality. That sentiment level is exactly what we're seeing right now. But these things, Grant, remind me exactly of like a small, tiny biotech stock, because we have like a press release saying, this large company is going to look at the technology and the coins pop like 30%. So, and there's
right,
no guarantee.
But that's what a bubble sounds like. That's what a bubble looks like. Look, the reason we've had all these stories about people that have bought Bitcoin and paid off their mortgage and their student loans in 10 minutes is because the price has just been going up. When the bubble bursts, and it will, and these things will find the right level. When the bubble bursts, then you're going to start hearing the stories about the people that sold their house and bought Bitcoin and ended up living in their parents' basement because they went bust in 24 hours. These things go until they stop, and then they go down. And the same way the Nasdaq went down 85%, the stocks didn't all go away, and the cryptocurrencies won't all go away, but they will need to find a sensible level, an equilibrium price where it's not speculative fever that's driving them up. When you talk about people mortgaging their house to buy Bitcoin and sell them the next day, that's what people do in bubbles. I mean, it's just the very epitome of bubble behavior. But as I said, look, good luck to everybody trading these things. I hope everybody makes a fortune. But to me, right now is not a time to put buy and hold money into Bitcoin.
I agree. Yeah, unless maybe you want to start a tiny little position and then buy if there's a big dip or something. But yeah, I wouldn't put my entire position right now. I think that would be very foolish. And there's a lot of people, unfortunately, Grant, and I've been trying to warn against this. I believe people should maybe own some Bitcoin, hold some cash in case there is a stock market crash, own some gold and silver and some mining shares. There's people who are liquidating their physical gold, their physical silver, their mining shares. Actually, a lot of the listeners on this podcast have done it already, telling me I'm a moron for recommending gold, silver, mining shares over the years, and then riding this cryptocurrency boom up. So best luck to them. Best luck to them. But if they do have profits, they should be taking them off the table. They should not be buying more and more, and adding almost 100% of their capital into Bitcoin and cryptos just because they're going up.
Yeah, no, I can't add anything to that.
I mean, I'm getting this almost daily now from people telling me that they're doing this. So, sentiment wise, this is a contrarian indicator. But I want to ask you now about the Federal Reserve and their balance sheet reduction program. I think they want one more interest rate increase this year, three more 2018, two more in 2019, and they want to increase. They want to start increasing the amounts that they sell off their balance sheet. They plan to sell off about over 100 billion total assets. Do you think that's meaningful, or do you think there's going to be another financial crisis before they're able, to accomplish this plan?
Well, look, I want a Bugatti Chiron. I mean, we can't all have what we want, unfortunately. I mean, look, what the Federal Reserve want and what the Federal Reserve are going to get, there's one thing I'm certain of: they won't be exactly the same. And the question that everybody needs to try and figure out the answer to is how different will they be, and in what way? Because if you think you can expand your balance sheet to 4.7 trillion from 800 billion in the space of 9 years, and there are no ill effects on the expansion, you think you can wind it back in and there will be no ill effects on the way back in. I'm sorry, you're just out of your mind. The ill effects on the way up have been massive increases in asset prices. And of course, when you're looking at the balance sheets of the world and the investors of the world, that doesn't look like a bad side effect. But if that's what's happened as this inflation has gone on, I'm talking about inflation of the balance sheets, then you can make a pretty good stab that what's going to happen as that trade goes the other way is that these overvaluations in asset prices also go back the other way. And then that does look like a problem. Rising prices don't seem to be a problem for anybody, and falling prices are. But when the rising prices are the kind we've seen with just no fundamental underpinning, that's a problem too. But everybody, if things are going up, no one really cares about that. It's not a problem to be dealt with today. It's a wave to ride. So I'm sure the Federal Reserve do want one more rate hike this year and 3 next year and 2 the year after. And I'm sure they do want to reduce their balance sheet by 10 billion a month, moving up to 50 billion a month. I'm sure they want that. And I'm sure they're all sitting around hoping and praying that they get it. But everything I've seen in my 30 years in this business tells me that's not what they're going to get. I don't know exactly how it's going to be different, but I'm pretty sure it will be different. And the big question is, how do both the Federal Reserve and global markets deal with those differences? And that is yet to be decided.
Yeah, and it's really not just the Federal Reserve at this point, Grant. It's really the European Central Bank, the Bank of Japan too, the Bank of England, and the People's Bank of China. They're basically, they've hitched each other's wagons together, kind of like the pioneers there trying to fend off the Native Americans on an attack, trying to save themselves, or a life raft. What is it, the daisy chain? They're trying to save themselves, and look at how much they've all expanded their balance sheets. I don't know if any of them can unwind at this point. The junk bond yields, I think, in Europe are now lower and pricing in less risk than U.S. Treasury bonds. So we've gone theater of the absurd here in terms of global central bank intervention. But these predictive models, the long-term trend, I don't hear this talked about enough. I know Revision TV just did kind of an interview about this with one of the guys who designs the models on Wall Street. How it's a great interview if you're a subscriber. How the models basically the new models only fix the problems with the old ones, and then there's new problems. But in general, I think the long-term track record, Grant, of these models in general is absolutely piss poor. Whether you're a Wall Street economist or a central banker making these models almost always fail, and they don't really have a good track record at all.
Yeah, I mean, look, models are made by taking things that happened in the past and extrapolating them into the future. And of course, that's never going to be a perfect fit. The problem comes when you look at the central bankers, for example. They try and tweak their models to get the number they really want, instead of the other way around. So, this whole idea of modeling the future. I mean, think about what investing is. Investing is making a series of hopefully educated guesses about an unknowable future. It's nothing more complicated than that. So nobody knows anything when they're investing. We're all making guesses about the future. Some guesses are educated, more so than others, and some are just wild stabs in the dark. And sometimes the best educated guesses are wrong, and sometimes the wild stabs in the dark work out just fine. There's no knowing. So anytime that the central bankers, for example, say, "Hey, look, this is what we're going to do, and this is how it's all going to happen," I mean, not only are they out of their minds, but anyone that sits back and says, "Oh, okay, well, this is what the central banks have said they're going to do. That's how it's going to all play out. So let's invest accordingly," isn't factoring in the fact that these guys are making a guess about the future. And I would add, they've been wrong in just about every guess they've made, not only about the future in the broad sense, but even their forecast for GDP, unemployment. I mean, you name it. I mean, if you can tell me a forecast the Federal Reserve has gotten right in my lifetime, I'd love to hear it. And that's not just these guys, but the ECB, the Bank of Japan. I mean, these guys are hopeless at getting right. If they were running a fund, they'd have been out of business decades ago. But people, because they are at the very spigots of monetary policy and can actually dictate terms to the rest of the world, people instill in them a degree of confidence and faith and belief that is entirely unwarranted in my opinion.
Yeah, exactly. If these guys were in the private sector, if these government PhD Keynesian economists were in the private sector, they probably would have been fired given their track records. But because, they're Janet Yellen has, with her husband, I think she has 3 pension plans, and she's a tenured academic. If she were to get fired or quit her job at the Federal Reserve, she can easily land on her feet. And either she would have a book deal to write nasty things about Trump and make 6 or 7 figures. She can do what Alton Greenspan or Bernanke are doing on the speaking circuit and make at least $50,000 per speech. Or she can go and consult like Bernanke is with a hedge fund and make big bucks doing that too. But I want to ask you now, do you think there's some major things about global markets or asset markets that Wall Street's missing, that they're overlooking, maybe because they're so short term?
Well, look, I think this everything is awesome mentality is wrong. I think the drum beats are getting louder and louder of the number of potentially dangerous banana skins that are laying out there, and so for Wall Street to continually bid up markets to all-time highs in the face of all kinds of potential danger is foolish in my opinion. But for the time being, I think the move to passive investing is certainly a big part of the blame for that. We've seen lots of active managers closing their funds because they can't compete with the passive funds anymore. And again, that's dangerous. Anytime you get investments herded into anywhere, whether it's being herded into passive or herded into hedge funds, it doesn't really matter. When it's all herded into one corner of the marketplace, if you will, it's dangerous. And I think passive is arguably the most dangerous place to herd everybody, because by its very definition, it's not really paying attention. It's just buying things based on a set of rules. And when the markets are going in one direction, those rules hold. When the market turns around and we see momentum shift, again, there's no paying attention. These algorithms will just sell, and when people start to sell ETFs, that I think is potentially a very dangerous cascade that could get started. And I don't think people realize the potential dangers of a sharply falling market that is largely based on passive investment strategies.
Yeah, Real Vision TV has been covering that really, really well. I know you had on a guy, I think from one of Peter Thiel's hedge funds, talking about that earlier in the year. I think there's been well over $60 billion just this year alone that's gone into the passive stock index ETFs. And Wall Street, Grant, is really good at taking risk with other people's money, trying to maximize returns, not necessarily thinking about the long term, not necessarily thinking about the downside. Obviously, there's people that are exceptions to that, but a lot of people on Wall Street, will try to maximize profits for their bonuses and to make high commissions and fees.
Yeah, absolutely. Again, nothing I can add to that.
Yeah, I wish things were different, but that's just like the short-term parasite, rent-seeking nature of Wall Street. I mean, the U.S. government and politicians are like that too, and so are bureaucrats. So there's a lot of flaws like that in the U.S. economic and political system. Are there any actual industries where you do think are undervalued, or do you think this central banker liquidity has basically made almost everything overvalued at this point?
Well, it's really hard to find. I mean, you can find individual stocks. We were interviewing Jim Rogers this past week, and he made a great point. He said if someone has got the time and energy to sift through stocks and find stocks that aren't in ETFs, then they're probably a good place to look. I still think gold mining stocks are undervalued. I think there are pockets. Again, this ETF phenomenon. Biotech is a great example. People want to get along the biotech ETF. Now, biotech is an incredibly nuanced space, and in that space you'll find some incredible companies doing amazing things. But it requires doing some work and not just buying a biotech ETF. When people say, do you see any sectors that are undervalued? That's kind of a byproduct of this ETF phenomenon. It's not about there being undervalued sectors. It's about there being undervalued companies. This is what investing is all about, finding companies that are priced incorrectly, not entire sectors. And that mindset that people have, as if all coal mining stocks are cheap. Well, no, they're not. There may well be some very underpriced coal mining stocks, but they're not all underpriced. So the whole point of being an investor is to actually work out a sector where you think there may be undervaluations, and then find the companies that offer you a chance to capitalize on those undervaluations. Buying a coal mining ETF, to me, is just a lazy way of doing that, and it's not the kind of investing I grew up doing. And I think ultimately it's a very dangerous way to invest your money.
That's a great point. Yeah, there's a lot of macro hedge funds that just want to, get exposure really quickly to gold mining ETFs or coal miner ETFs. But, you got to go in there and you got to figure out with a commodity resource company, it's about, grade or costs, how bad the balance sheet is, if they can survive a lower commodity price, and for how long. So there's those factors that.
But we're talking about the difference between investing and trading here, right? I mean, if you want to invest in gold mining stocks, go and look at some companies and work out which ones you want to invest in. If you think the gold miners are going to move higher because gold's going to move higher because the dollar's going to go weaker, or whatever you think, fine, buy the ETF. If you want to just trade this thing and catch a bounce in the price, or short it if you think the price is going to fall, that's fine. But when you want to talk about investing, it's this idea about undervalued sectors or overvalued sectors that just kind of drives me a bit nuts, frankly. This idea that everything in biotech is overvalued, or everything in resources is undervalued. It just doesn't make sense to me. But that is, to me, the clearest indication of this passive investing ETF bubble, is that sectors all move together, and what used to make the best investors were the guys who could look through the companies and they'd buy all the winners and they'd sell all the guys that they thought were just overpriced or not as well run or didn't have as good a business. That's what investing used to be, but it's not anymore. It's just buy the coal miners.
Yeah, that's a very important distinction. I think a lot of people are getting lazy. When I see a lot of firms on Wall Street looking to hire people, they're looking to hire people that are quants that can do this at a high level and not dig down deep and do the bottom up fundamental research. I don't see as many of those positions available as they used to. It seems like a lot more people want like computer programmers who can program high frequency trading machines or AI trading systems or quants rather than bottom up fundamental investors.
Well, the alternative explanation is that I'm just a grumpy old man, which I'm very willing to listen to anybody that wants to counter my argument with that. I would find that a very difficult contention to argue against.
Well, Grant, I really enjoyed our discussion today, and please tell our listeners more about your work, including your new podcast and your newsletter and Real Vision TV.
Sure, I'd be delighted to. So my newsletter is called Things That Make You Go I've been writing it for, about 8 years now, I think. You can find more about that at ttmygh.com. And then Real Vision Television is a project that I started a few years ago with my buddy Raoul Pal. And it's just an idea about us to try and, as we put it, democratize financial information and bring as many of the smartest minds we could find in the world of finance to a much bigger audience. And part of that has been the launching of our podcast, Adventures in Finance, which you can find on iTunes or just Google Adventures in Finance. And we just try and talk to smart investors and, above everything else, learn lessons from them, find out about the mistakes they made and find out the lessons they learned from them in the hopes that we can perhaps save future investors from making those same mistakes. So it's been a lot of fun, and we've met some incredibly smart, engaging people.
You guys are doing great work over there, and it's a very difficult environment. You know it's very difficult when you have superstar billionaire hedge fund managers like Hugh Hendry, who's had a long track record of success, and lately the last couple of years his fund hasn't been doing well, and he basically had to shut it down. So it's a difficult environment when you have people as smart as Hugh Hendry struggling like this.
Yeah, absolutely. And I actually interviewed Hugh for Adventures in Finance on the day he was closing his fund, and he was remarkably upbeat, remarkably open and frank about the whole thing, and it was a bittersweet pleasure for me to talk to him in the last hours he had as a hedge fund manager. He's a great guy, and I've got a tremendous amount of admiration for him, and I'm sure when he decides to be back, he'll be back, and he'll be just as good as he ever was. But it is a shame. It's a shame to see guys of that caliber closing their funds down, and I think that's just a symptom of the environment we're in.
Exactly. Well, thank you for your time, Grant, and I always enjoy my discussions with you, and I enjoy your content on Real Vision TV. I saw the Kyle Bass interview a couple days ago. That was excellent, and I just saw you put up the Jim Rogers interview, so I'm going to get to that. Looks like it's over an hour, so I'm going to get to that hopefully later today.
Yeah, it's a fantastic interview with my buddy Steve Diggle.
Wall Street for Main Street needs your help. Since the middle of 2016, YouTube continues to increasingly censor and sabotage the growth and success of my channel with dramatically slower or no subscriber growth, a huge decrease in views per month compared to 2016, and well over $10,000 lost in Google AdSense revenues the last 18 months. I should have been way over 20,000 subscribers and way over 3 million views last year, but it feels like I am Sisyphus trying to roll a heavier boulder with more and more additional weight up a steeper and steeper hill. In the last few weeks, all of my videos have been set to demonetization by default, and I have to manually protest each video. This is in addition to even lower than usual Google AdSense revenues after the adpocalypse started over a year ago for me. This has also affected my ability to get paid advertisers to agree to deals not involving YouTube, as I lost $3,000 per month in paid advertising deals at the end of June 2017 because all my analytics are down a lot thanks to YouTube censorship algorithms that have intentionally kneecapped the growth of my channel. With YouTube /Google /Alphabet /Don't Be Evil strongly considering demonetizing or setting all libertarian, conservative, or pro-Trump content to private to prevent any sharing or monetization, it is imperative I have a contingency plan to figure out how to make a living off my content. Each 30 to 40 minute video takes a few hours of my time before it's released to the public. There's a strong possibility that in the near future, YouTube will force me to move all or almost all my content to a new video upload website that allows free speech or behind a paywall on my own website. Thanks if you have already made a one-time or recurring monthly donation, and thanks in advance for any future donations as I decide the future of my channel and what to do with my content going forward. We accept one-time donations on the Wall Street for Main Street website via PayPal, Bitcoin, or Gold Money. You can also become a monthly Patreon contributor for $1 or more a month if you want to help me out. And don't forget to like each video on YouTube and share it with your friends and family if you think they would like the content.